I almost titled this video like why tokenized real world assets might be the best inflation hedge in 2026. And honestly, that title would probably get clicks. But the more I looked at it, the more I disliked that sentence because it is dangerous. Tokenization is not the hedge. Tokenization is the access layer. And if you confuse those two things, you can be right about the trend and still wrong about the investment. So this is not a gold is dead video. Gold is still gold. For decades, the inflation hedge story was simple. Gold, real estate, tips, commodities, energy, and sometimes Bitcoin. But in 2026, I think that old debate is missing the sharper story. This is not RWAs save everyone, and it is definitely not put a token on something and congratulations, you invented protection. The more interesting question is not just what asset protects you from inflation. The more interesting question is who gets access to inflation-sensitive assets first, who controls the wrapper, and who gets paid when those assets become collateral. Because while most people are still arguing about gold, Bitcoin, Treasury bills, and real estate, Wall Street is quietly moving pieces of the real-world asset market on-chain. Treasury funds, gold tokens, private credit, commodity exposure, fund shares, and eventually maybe infrastructure or energy-linked cash flows. That sounds exciting, and it is the perfect place for people to get sloppy. So this video is going to be a detective story. The next inflation hedge might not be gold, but the suspect is not crypto either. The suspect is tokenized access to real assets. And the first clue is the most important one. Tokenization does not create an inflation hedge. It creates a wrapper, a distribution rail, and sometimes a collateral rail. The hedge still has to come from what is inside the wrapper. If you tokenize a bad asset, it is still a bad asset. If you tokenize a dollar, it is still exposed to the dollar losing purchasing power. If you tokenize a treasury bill, you may have a useful yield product, but that does not automatically mean you are protected from inflation. So the real question is not, is this on-chain? The real question is, am I buying protection or am I buying access? Because those are not the same thing. Access is not protection. A modern dashboard can look great. The yield can look attractive. The token can move instantly. But none of that answers the boring question. What do I actually own? Educational research only. This is not financial advice, not legal advice, and not a recommendation to buy or sell anything. Let's start with why this story matters right now. No, inflation did not disappear. It just became more complicated. The New York Fed's June 2026 survey of consumer expectations showed one-year inflation expectations rising to 3.7%, three-year expectations rising to 3.3%, and five-year expectations staying at 3.0%. That is not a hyperinflation panic. I do not want to overstate it, but people do not experience inflation as a chart. They experience it when insurance renews higher, groceries reset higher, rent does not come back down, and cash in the bank starts feeling less like safety and more like slow leakage, and that is why expectations matter. When people think cash is leaking value, they start looking for something that does not leak as fast. The Fed's own projections tell a similar story. In the June 2026 summary of economic projections, the median core PCE inflation projection for 2026 moved up to 3.3%. The St. Louis Fed summarized that as a revision from 2.7% in March to 3.3% in June. Not the end of the world, but enough to keep the inflation hedge conversation alive. And that is where the business opportunity starts. Inflation anxiety creates demand for protection. Demand for protection creates demand for real assets. Demand for real assets creates demand for access. And access is exactly the thing Wall Street knows how to package. That is the part I think people are underestimating. The product being sold may sound like an inflation hedge, but the business being built may be a toll road into real assets. And this is why I care as an investor. The buyer may think they are buying protection, but the real money may be made by the companies controlling issuance, custody, compliance, settlement, and collateral. This is a question about where the economics of the next real asset access layer might land. And this is where the mystery begins. When people hear inflation hedge, they usually jump straight to one asset: gold, Bitcoin, real estate, tips, energy. But that is the old question. The new question is, what happens when the assets people use to protect purchasing power become easier to slice, trade, settle, borrow against, and move between platforms? That is the tokenization question. And if this kind of plain English market map is useful, subscribe. The goal here is to separate the real mechanism from the marketing fog, one episode at a time. Because the word tokenized can make almost anything sound futuristic. Tokenized gold, tokenized treasuries, tokenized real estate, tokenized private credit. But the detective rule is simple. Never trust the shiny label before you inspect the asset, and never confuse a better entrance with a safer building. So throughout this video, I am using one recurring test: the RWA stress test. What is the asset? What is the legal claim? What is the inflation link? Who holds custody? How do I exit? And who gets paid before me? If a tokenized product cannot answer those 6 questions, I do not care how futuristic it sounds. First suspect, tokenized cash. Stablecoins, tokenized treasury bills, and tokenized money market funds. These are probably the most successful real-world asset products so far because they solve a real problem. They make dollar settlement faster, move yield around more easily, connect traditional cash-like instruments to crypto rails, and help traders, institutions, funds, and platforms manage collateral without waiting on the old banking schedule. But here's the trap. A better dollar rail is not the same thing as protection from the dollar losing purchasing power. If I hold a dollar stablecoin and inflation runs hot, I still hold a dollar claim. It may move 24/7, it may settle quickly, it may be useful as collateral, but it does not magically become an inflation hedge because it lives on a blockchain. That is like putting a faster engine on a car pointed in the wrong direction. Very impressive engine, still the wrong direction. Tokenized treasury bills are a little more interesting because they can pay yield. If short-term interest rates are high, a tokenized T-bill product can be a useful cash management tool, assuming the risk, fees, legal structure, and access rules make sense. But even there, the language matters. A treasury bill is a nominal instrument. Nominal just means the payment is in dollars, not automatically adjusted for inflation. If the yield is 4% and inflation is 3%, maybe you are ahead before fees and taxes. If the yield is 4% and inflation is 5%, your statement may look fine, but your purchasing power is still slipping. Here's the first stress test. Imagine inflation is running above your yield after fees and taxes. Your tokenized treasury product may work perfectly. The smart contract may work. The custody may work. The dashboard may look clean. The token may move quickly. But your purchasing power can still fall. That is not a technology failure. That is a job description failure. You hired a cash management product to do the job of an inflation hedge. That is why I would not call tokenized treasuries a pure inflation hedge. They are closer to better cash. Useful? Yes. Important? Yes. An inflation hedge by itself? Not really. If you want the clean government-designed inflation product, the classic example is TIPS. Treasury Direct explains that the principal of a TIPS goes up with inflation and down with deflation. And at maturity, the investor gets the higher of the inflation-adjusted principal or the original principal. That is an inflation link. A tokenized T-bill does not automatically have that link. So clue 1 is this. Tokenized cash may solve settlement and yield. It does not solve purchasing power by itself. It is an access product, a settlement product, and maybe a collateral product. But if someone sells it to you as inflation protection, slow down. The wrapper is doing one job. The hedge is a different job. And I want to be clear, I am not dismissing this. Tokenized cash may become one of the most important pieces of financial plumbing in the world. I just would not confuse plumbing with inflation protection. This is the question that should sit over the whole video. Treasury bills, gold ETFs, physical gold, and REITs already exist. So the right question is not, does the token sound new? Tokenization may improve settlement, fractional access, collateral use, programmability, and distribution. It may make an asset easier to move, split, and plug into a wallet-based financial system, but it may not improve the legal claim, fees, tax treatment, liquidity, or underlying asset quality. So the old versus tokenized question is not which one sounds more futuristic. The question is, what did the token actually improve? If the answer is only marketing, that is not enough. Now, gold. If you are making a video called "The Next Inflation Hedge Might Not Be Gold," you have to investigate gold first. Tokenized gold is one of the cleaner RWA stories because the underlying asset is familiar. People understand why gold might matter when inflation anxiety rises, currency trust falls, or investors want something outside normal credit. Tokenized gold adds a different access layer. Instead of buying a physical bar holding a gold ETF or using a futures contract, a person can hold a token that claims exposure to gold. That can add 24/7 transferability, fractional ownership, collateral use, and crypto-native wallet access. That is not nothing. RWA XYZ data from this research pass showed tokenized commodities with about $4.6 billion in distributed value and about $3.1 billion in represented value. 2 gold-backed products alone were large enough to matter. Tether Gold around $2.49 billion in total asset value, and Paxos Gold around $1.85 billion. So this is not just theory. There is real money in the market. But the detective does not stop when the suspect looks obvious. Tokenized gold creates a new set of questions. Where is the gold stored? Who audits it? Can token holders redeem it? What is the minimum redemption size? What happens if the issuer or custodian has a legal problem? What law governs the claim? And if I need to sell during a stressful market, is there actually enough liquidity? This is the part people skip because it is boring. But boring is where the bodies are buried in finance. The token is not the gold. The token is a claim, a receipt, a representation, or an access point, depending on the structure. That distinction matters. Here is the second stress test. Imagine gold rises during an inflation scare. Imagine gold goes up 25%. The headline hedge worked. But your token still trades at a discount because redemption is limited, liquidity dries up, or people suddenly care about the issuer's balance sheet. In that moment, you were right about gold, but wrong about the wrapper. In that scenario, gold may have done its job, but the access product may still disappoint you. That is the distinction. Gold can be an inflation hedge. A tokenized gold product is a structure around gold. The structure can improve access, but it can also add custody, redemption, liquidity, legal, and platform risk. If a token gives you clean, audited, enforceable, redeemable exposure to gold, then tokenization may make gold easier to use. But if the legal claim is weak, the custody is murky, or the exit is thin, the token can add a new layer of risk on top of the old gold story. So tokenized gold is a real suspect. It is probably the easiest inflation hedge RWA for people to understand, but it is not the full case because gold protects by being gold. Tokenization changes how the claim moves, who can use it as collateral, and who gets to collect fees around that movement. Again, I am not dismissing tokenized gold. If the reserves, claim, custody, redemption, and market depth are real, tokenized gold can be useful. The point is that you still have to inspect the structure. Here is where I think the story gets more interesting. The next inflation hedge might not be a shiny metal. It might look like a contract, a toll road, a warehouse, a power asset, a loan book, or a cash flow stream that can reprice as the world gets more expensive. Think about real estate, infrastructure, energy assets, floating rate credit, productive land, storage, transportation, and commodity-linked businesses. Not all of them protect you from inflation. A bad building with too much debt is still a bad building. But some of these assets have rents, contracts, interest rates, or pricing power that can adjust when nominal prices rise. That is a different kind of inflation hedge. It is not just this thing is scarce. It is this asset may collect cash flows that move with the price level. And that is exactly where tokenization gets interesting. Historically, many of these assets were hard to access. Private credit, infrastructure, commercial real estate, farmland, and energy assets often came with high minimum, slow settlement, limited transparency, or lockups. Tokenization promises to lower minimums, improve record keeping, divide ownership, connect assets to programmable collateral systems, and automate distributions and transfers. That is the bullish version. But notice the word I used, promises, because tokenization can make access easier, but it cannot make the underlying asset good. Tokenized private credit is still credit. Someone has to repay. Here is the third stress test. Take tokenized private credit. The pitch may say floating rate income. That sounds attractive if inflation stays sticky and rates stay high. But floating rate income means the borrower is also paying a floating rate cost. If rates rise too much, the lender may earn more until the borrower breaks. Then the question is not, what is the APY? The question is, what is the recovery value, who is senior, and how fast can I get out? Same with real estate. A rent escalator can help, but if insurance, taxes, maintenance, financing costs, and vacancy rise faster than rents, the token holder may not feel protected. The asset has to survive the inflation environment. The token does not survive it for you. That is why the cash flow version of this story is more interesting, but also more dangerous. If the borrower cannot pay, the loan documents are weak, the collateral is overvalued, or there are no active buyers, the token does not save you. But again, the point is not RWAs are bad. RWAs can be powerful if the asset, claim, custody, and exit are real. The lazy version is RWAs hedge inflation. The better version is some real assets may hedge inflation, and tokenization may change who gets access to them. RW8XYZ showed tokenized credit at about $6.56 billion in distributed value and about $24.5 billion in represented value during this research pass. That is big enough to take seriously. But credit is not an inflation hedge just because it pays a high yield. A high yield can mean compensation for risk, illiquidity, default risk, or leverage hiding somewhere in the structure. So the question is not, does this yield more than cash? The question is, why does this yield exist, and what breaks if inflation stays sticky or the economy slows? That is the real investigation. Now let's zoom out. The RWA market is no longer imaginary. RWA.XYZ showed about $33.5 billion of distributed real-world asset value, excluding the much larger stablecoin category, as of July 8th, 2026. It also showed about $300.7 billion of stablecoin value. You can argue about definitions, methodology, and which assets should count. But the broad point is hard to ignore. Real-world assets are moving into tokenized structures. Some of this is boring cash management. Some is genuine market infrastructure. Some is regulatory experimentation. Some is probably marketing wearing a lab coat. But the category is real enough that it deserves a serious framework. The Bank for International Settlements and CPMI defined tokenization as generating and recording a digital representation of traditional assets on a programmable platform. That definition is helpful because it removes the hype. Tokenization is not a spell. It is record-keeping, ownership representation, and transfer logic on a programmable system. That can improve efficiency, reduce settlement friction, make assets more composable, and help with reconciliation. But it also creates new dependencies. Smart contracts, custodians, oracles, transfer agents, wallet allow lists, legal wrappers, regulated venues, market makers, and auditors. And sometimes a pile of terms and conditions that most people will not read until something goes wrong. This is where the thesis gets more specific. The biggest opportunity may not be tokenized assets beat inflation. That is too broad. The bigger opportunity may be Who turns real assets into usable financial plumbing? Who issues the products, custodies the assets, audits the reserves, runs the transfer rails, makes the markets, provides the compliance layer, decides what can be posted as collateral, and controls the on-ramps and off-ramps? That is where the business model may live. If tokenized gold becomes useful collateral, someone earns fees. If tokenized treasuries become the cash layer for settlement, someone earns fees. If tokenized credit becomes investable through new platforms, someone earns fees. The buyer may be looking for inflation protection. The platform may be selling access, settlement, custody, and collateral utility. Those are related, but they are not the same thing. That is why I do not like blanket statements like, RWAs are the best inflation hedge. That sentence is too lazy. RWAs are not one asset. They are wrappers around very different assets. A tokenized treasury, a tokenized gold bar, a tokenized private loan, and a tokenized real estate claim do not have the same risk. This is the twist in the case. Tokenization sounds like liquidity. It sounds like if an asset becomes a token, it should be easier to trade. Sometimes that is true, but not automatically. Liquidity is not a file format. Liquidity means there are buyers and sellers, real venues, market makers, clear rules, tight spreads, enough depth, and a legal structure that allows transfers to actually settle. An ArcShift paper called Beyond TVL argues that tokenized real-world assets are often judged by headline value. But a large asset base can still hide liquidity risk, concentration risk, and weak market quality. Another 2026 paper, Tokenized but illiquid, makes the key distinction. On-chain representation and secondary market liquidity are different outcomes. On-chain representation and liquidity are not the same thing. A token can be transferable 24/7 and still have nobody on the other side of the trade. You can tokenize a building. That does not mean someone wants to buy your fraction of the building at 9:43 p.m. on a Sunday. You can tokenize a private loan. That does not mean a deep secondary market exists when credit spreads widen. You can tokenize a fund share. That does not mean redemption terms disappear. The European Central Bank made a similar point about tokenized money market funds. Faster settlement, near 24/7 availability. Programmability and collateral use cases can still come with familiar risks like liquidity mismatches and operational fragilities. That is the adult version of the RWA story. Benefits are real. Risks are real. The wrapper changes the plumbing, not the laws of finance. This is why I think the detective framework matters. The question is not, is this tokenized? The question is, what changed because it is tokenized? Did access, settlement, transparency, collateral use, or secondary liquidity actually improve? Or did someone just put a token on a hard-to-exit asset and call it innovation? Because if the exit door is tiny, putting neon lights around, it does not make it bigger. And this is the point where a lot of RWA hype gets too casual. On-chain transferability is a technical feature. Liquidity is a market outcome. Those are different. You can build the road. That does not mean traffic shows up when you need it. So here's the scorecard I would keep on screen for any tokenized inflation hedge. First, what is the asset? Second, what is the legal claim? Third, what is the inflation link? Fourth, who holds custody? Fifth, how do I exit? Sixth, who gets paid before me? 2 bonus questions. Who profits from the wrapper? And what would prove the thesis wrong? For a tokenized gold product, maybe the risk is custody, redemption, or discount risk. For tokenized treasuries, maybe the risk is that the product is useful, but not actually an inflation hedge. For tokenized private credit, maybe the risk is default and weak liquidity at exactly the wrong time. For tokenized real estate, maybe the risk is that property values and rents do not adjust fast enough, while financing costs and insurance rise immediately. If a tokenized asset cannot survive that stress test, I do not care how futuristic it sounds. So here's my final verdict. The next inflation hedge might not be gold, but it is probably not RWAs as a lazy category either. The winning idea is more specific. Inflation pushes people toward real assets. Tokenization may decide who gets access to those real assets, how fast they can move, whether they can be used as collateral, and who controls the toll road. That is the real story. Gold is still gold. Treasury bills are still treasury bills. Real estate is still real estate. Private credit is still credit. Tokenization does not erase the old questions. It adds new ones. And the inflation hedge conversation may shift from which one asset should I own to which real assets have enforceable claims, durable cash flows, actual liquidity, and collateral value. That is less exciting than gold is dead or RWAs will save everyone, but it is more useful. My view is this. Tokenized cash is the settlement layer. Tokenized treasuries are the yield layer. Tokenized gold and commodities are the classic hedge layer. Tokenized real estate, infrastructure, and credit are the cash flow layer. The business opportunity is the access layer. The investor risk is confusing that access layer for protection. That is why I am interested in RWAs, but I refuse to be lazy about them. The real work is figuring out which layer is actually doing the job you think it is doing. The worst mistake would be buying an access product and thinking you bought protection. Access is not protection. Liquidity is not guaranteed. Yield is not safety. And a token is not automatically a hedge. The hedge comes from the asset, the contract, the custody, the legal claim, the cash flow, and the market structure around it. That is the case. Inflation made people search for real assets. Tokenization may decide who gets access. The next inflation hedge might not be gold. It might be the first real asset you can actually verify, understand, enter, and exit without needing a Wall Street invitation. But if all you bought was a shiny access token with a weak claim and a tiny exit door, then you did not buy a hedge. You bought a wrapper,